This question tests knowledge of the Public Company Accounting Oversight Board, PCAB, and its role in protecting investors through high-quality audits of public companies. The PCAB establishes auditing standards that external auditors must follow when examining the financial statements and internal controls of issuers. A major requirement under the Sarbanes-Oxley Act, SOX Section 404, is that management assesses the effectiveness of internal control over financial reporting, while the external auditor performs an integrated audit that combines the audit of financial statements with the audit of internal control over financial reporting. Students should distinguish PCAB auditing requirements from other securities regulations, such as ownership disclosures, executive compensation reporting, or corporate governance practices. The question asks which requirement is most directly associated with the PCAB's investor protection objective. A. Integrate an internal control audit with the financial statement audit. Correct. PCAB auditing standards require auditors of many public companies to perform an integrated audit, evaluating both the financial statements and internal controls over financial reporting. B. Disclose the identity of owners with more than 5% ownership interest. Incorrect. This is a securities disclosure requirement, not a PCAB auditing requirement. C. Disclose executive compensation and bonuses. Incorrect. Executive compensation disclosures are governed by SEC reporting rules rather than PCAB audit standards. D. Have an independent audit committee within the board of directors. Incorrect. Although SOX promotes independent audit committees, this is a corporate governance requirement rather than the PCAB's primary audit requirement. Correct answer, A. Integrate an internal control audit with the financial statement audit. This question examines the components of audit risk, a fundamental concept in auditing and internal control. Audit risk is the possibility that an auditor expresses an inappropriate opinion when the financial statements contain a material misstatement. Audit risk consists of three elements: inherent risk, control risk, and detection risk. Inherent risk is the susceptibility of an account or transaction to error before considering controls. Control risk is the possibility that the client's internal controls fail to prevent or detect material misstatements. Detection risk is the risk that the auditor's procedures will fail to detect existing material misstatements. The question specifically asks about the risk associated with the auditor failing to identify material misstatements, making it essential to distinguish auditor-related risk from risks arising from the client's business or internal control system. A. Control risk. Incorrect. Control risk relates to the failure of the client's internal controls to prevent or detect material misstatements, not the auditor's failure. B. Inherent risk. Incorrect. Inherent risk reflects the natural susceptibility of an account balance or transaction to material misstatement before considering internal controls. C. Unsystematic risk. Incorrect. Unsystematic risk is an investment and portfolio management concept, not an auditing concept. D. Detection risk. Correct. Detection risk is the risk that audit procedures fail to detect material misstatements that exist in the financial statements, leading to an inappropriate audit opinion. Correct answer, D. Detection risk. This question tests understanding of the internal control provisions of the U.S. Foreign Corrupt Practices Act, FCPA. The FCPA requires companies whose securities are registered in the United States to maintain accurate books and records and establish a system of internal accounting controls that provides reasonable assurance that transactions are properly authorized and recorded. The question asks for the exception, meaning the option that is not a violation of the FCPA's internal control provisions. Students should distinguish between legal requirements under the FCPA and best practices in corporate governance. While organizations often adopt the COSO framework to strengthen internal controls, the FCPA does not mandate the use of COSO. Instead, it requires effective internal controls and accurate accounting records to prevent concealed or unauthorized transactions, such as off-the-book bribery payments. A. Use of bribery payments. Incorrect. Bribing foreign officials and concealing the payments violates the FCPA's anti-bribery and accounting provisions. B. Failure to use the COSO framework for internal controls. Correct. The FCPA does not require companies to adopt the COSO framework specifically. COSO is a widely accepted framework, but its use is voluntary rather than legally mandated. C. Failure to have internal controls to ensure that transactions were appropriately recorded. Incorrect. The FCPA requires adequate internal accounting controls and accurate recording of transactions. D. Lack of a compliance program as part of its system of internal controls. Incorrect. Although the FCPA does not explicitly prescribe a compliance program, the absence of such controls may contribute to an inadequate internal control system supporting compliance. Correct answer, B. Failure to use the COSO framework for internal controls. This question assesses knowledge of the internal control provisions of the U.S. Foreign Corrupt Practices Act, FCPA. The FCPA requires issuers to maintain accurate books and records and establish a system of internal accounting controls that provides reasonable assurance that transactions are properly authorized, recorded, and reported. However, the Act is principles-based rather than rules-based. It does not prescribe a specific internal control framework or a mandatory list of controls that every company must implement. Instead, each organization is expected to design controls appropriate to its size, complexity, and risk profile. Students should focus on identifying the statement that is false, since the question asks for the exception. Understanding the distinction between mandatory legal requirements and recommended best practices is essential when answering questions on the FCPA. A. The FCPA prescribes a particular set of internal controls that companies are required to develop and implement. Correct answer. This statement is false because the FCPA does not mandate a specific internal control framework or detailed control procedures. It only requires companies to maintain adequate internal accounting controls. B. Internal controls are used by companies to help provide reasonable assurance regarding reliability of financial reporting. Incorrect. This is one of the primary objectives of internal controls under the FCPA.C. Access to company assets is permitted in accordance with management's general and specific authorization. Incorrect. This reflects an important requirement of effective internal control systems. D. Good internal controls can help prevent not only FCPA violations, but also other illegal or unethical conduct. Incorrect. Strong controls reduce the risk of fraud, misconduct, and regulatory violations. Correct answer, A. The FCPA prescribes a particular set of internal controls that companies are required to develop and implement. This question tests knowledge of information system security, specifically the distinction between a computer virus and a Trojan horse. Both are forms of malicious software, malware, but they operate differently. A computer virus is malicious code that attaches itself to a legitimate program or file and is capable of replicating itself, spreading from one system or file to another when the infected program is executed. In contrast, a Trojan horse disguises itself as a legitimate application to trick users into installing it, but it does not self-replicate. Instead, it typically creates unauthorized access, steals information, or installs additional malware. Students should focus on identifying the unique characteristic that distinguishes a virus from other types of malware. Understanding these differences is important in evaluating information technology controls and cybersecurity risks within an organization's internal control environment. A. Corrupt data. Incorrect. Both viruses and Trojan horses can damage or corrupt data, so this is not a distinguishing feature. B. Alter programming instructions. Incorrect. Various types of malware can modify programs or system files. C. Replicate itself. Correct. The defining characteristic of a computer virus is its ability to self-replicate and spread by infecting other files or programs, unlike a Trojan horse. D. Erase executable files. Incorrect. Some viruses may delete files, but Trojan horses and other malware may also perform similar destructive actions. Correct answer, C. Replicate itself.